Price moves all week, but it never becomes free. The higher map keeps pulling it back. Before we enter any 1-hour trade, we need the bigger chart in our head. Monthly, weekly, daily, especially weekly. The 1-hour chart gives the execution, but the weekly chart shows where the market is trapped. If you skip that map, the candle can fool you. A breakout looks strong. You enter late. A pullback looks small. You hold too long. A target looks open, but the higher structure is already blocking it. That is how accounts bleed. Not from one wrong direction, from entering without location. This week we move through the 1-hour sessions first, Monday to Friday. Each day gives a different trade decision. One session gives a clean long. Another session gives a short that pays. Another setup looks tradable, but the risk is wrong. Another setup has a decent ratio, but the timing is bad. That is real trading. Not every line becomes a trade. Not every breakout deserves entry. Not every 2-hour setup deserves risk. We will move through the session structure as if the trade is happening now. Where does the session form? Where does price reach? Where does it fail? Where does it return? Where is entry? Where is stop? Where is target? If those lines do not fit, we do not force the trade. If the line holds but reward is weak, we skip. If the ratio is good but the session is late, we still think twice. If price reaches old memory and fails to stay, the opposite side can appear. After the 1-hour sessions, we step back. Daily, weekly, monthly. That is where the week becomes clear. The daily chart shows why the 1-hour longs had limited space. The weekly chart shows why the upper move could not stay free. The monthly chart shows why the whole market is still fighting the 2026 lower boundary near the 0.5 area. So do not watch this like a recap. Use it like preparation. This week already traded, but the structure does not disappear. The same memory can return next week. The same boundary can become the next entry. The same failed reclaim can become the next short. The same midpoint can become the next stop. We are not guessing the future. We are preparing for the next reaction. Price reaches. It reacts. It holds or fails. Then we execute. That is the frame for this week. Price pushes higher, but the box still controls it. The session forms inside expanded memory. May 24th Asia session forms between April 21st U.S. session midpoint and May 21st U.S. session midpoint. It does not compress quietly. It expands wide. It overlaps old memory. That matters. When a session basis box expands, the trade gets more space. But the risk also gets wider. The candle can move more. The reaction can move deeper. The stop cannot be placed carelessly. A small box can trap with noise. A large box can trap with range. Both can hurt the account. May 24th Asia session forms with a large range. Price starts inside that expanded structure. Then price pushes higher. It breaks above May 22nd U.S. session upper boundary. That is the first important move. Price does not just touch the line. It crosses above it. It tries to create distance. Then price moves higher again. It reaches May 21st U.S. session upper boundary. Now the trade feels strong. But strength still needs holding. If price breaks above May 22nd U.S. upper boundary and immediately returns, the move is not ready. If price holds above the break and keeps distance, the long can work. That is where execution begins. Long entry line. May 24th Asia session upper boundary. Stop loss line. May 24th Asia session midpoint. Take profit line. May 22nd U.S. session upper boundary. Risk-reward ratio. 1.58. The entry sits at May 24th Asia session upper boundary. Why there? Because the session expanded. The upper boundary becomes the first line, where buyers must prove control. If price cannot stay above that upper boundary, the breakout has no base. If price breaks above it and keeps holding, the long has structure. The trade does not start because the candle looks green. It starts because price leaves the expanded Asia box and does not immediately return. That is the difference. A green candle can be late. A held boundary can be entry. The stop sits at May 24th Asia session midpoint. That stop is important. In a wide session box, using the lower boundary as stop can make the risk too deep. The reward may not pay enough, so the midpoint becomes the damage line. If price breaks above the upper boundary, but returns to the midpoint, the breakout has lost control. The long is no longer clean. The move has returned to balance. That is where the position must be protected. Not because the midpoint is comfortable, because price has given back too much. The target sits at May 22nd U.S. session upper boundary. That target connects to recent memory. Price already broke above it later. But from the entry, that line is the first old boundary that must be reached and tested. A target should not be random. It should sit where price has a reason to react. May 22nd U.S. upper boundary gives that reason. Price reaches. It reacts. It either holds or fails. Now the problem. Risk-reward ratio is 1.58. It is usable, but it is not huge. That means execution must be clean. Entry cannot be late. Stop cannot be widened without reason. Target cannot be chased after price already moved. If the trader enters late, after the price already runs toward May 22nd U.S. upper boundary, the ratio weakens. If the trader widens the stop below the midpoint, the ratio weakens. If the trader moves the target higher without price earning distance, the trade becomes hope. So the long must be taken near the actual line. May 24th Asia upper boundary, not far above it. Now compare trader types. An aggressive trader may tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The long pays faster, but the cost is real. A tight stop can be touched by normal reaction. The structure may still be valid. The position may already be gone. That is the pain. You are right about direction, but you cannot collect. A conservative trader does the opposite. The stop is not too tight. The position size becomes smaller. The trade gets room. The chance of losing the position before the target decreases. But the stop distance is deeper. The reward must still pay. If the deeper stop makes the ratio too weak, the conservative answer can become no trade. That is real discipline. Not every valid idea deserves entry. A good-looking long can be skipped if risk does not deserve the reward. Now price continues. It breaks above May 22nd U.S. session upper boundary. It reaches May 21st U.S. session upper boundary. The target works. The trade has paid. Now the next question appears. Do we trail? Trailing is not automatic. A trail needs distance. A trail needs holding. A trail needs enough profit to protect. If price reaches the first target and stalls immediately, take the result. If price reaches the first target and keeps building distance, a trail can be considered. A useful trailing interval usually needs at least about 0.5 risk-reward unit of additional movement. Less than that often becomes noise. If you trail too early, you suffocate the position. If you trail too late, you give back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far back, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and keeps distance, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same rule continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the percentages do not create the trade. They only manage a trade that already has structure. May 24th Asia gives the first lesson. The session expands. The range gets wide. The long can work, but risk gets heavier. The entry must be near May 24th Asia upper boundary. The stop must protect the idea at May 24th Asia midpoint. The target must connect to May 22nd US upper boundary. Risk-reward ratio 1.58. Price moves higher. But the box still controls the decision. Price compresses again. But compression does not give permission. The session forms inside old memory. May 25th U.S. session forms near May 22nd U.S. session midpoint. It compresses to about 30%. It overlaps there. That matters. A 30% compression is tight. The box is small. The decision can come fast. But a small box can also create false confidence. A trader sees the tight structure. A trader wants quick entry. But quick does not mean clean. May 25th U.S. session first pushes higher. It reaches April 27th U.S. session lower boundary. That level matters. It is older memory. It is not just a nearby line. It is a place where price has reacted before. Price reaches it. It tests. It cannot build clean freedom. Then price turns down. It breaks below May 22nd U.S. session upper boundary. Then price returns into May 25th U.S. session box. Now the market is showing both sides. It pushed up. It failed to stay free. It dropped back. It returned into the compressed structure. That is the pressure. Now the long setup must be read carefully. Long entry line. May 21st U.S. session upper boundary. That line overlaps. May 25th U.S. session midpoint. Stop loss line. May 22nd U.S. session lower boundary. Take profit line. April 27th U.S. session lower boundary. Risk-reward ratio 2.07. This long does not come from chasing the first push to April 27th memory. That would be late. The long comes from May 21st U.S. upper boundary, overlapping the May 25th U.S. midpoint. That overlap matters. When the session midpoint and older memory overlap, the line gains weight. Price must decide there. If price holds above it, Buyers can attempt another push toward April 27th U.S. lower boundary. If price loses it, the long has no base. So the entry is not the high. The entry is the line, where price must hold before the high. May 21st U.S. upper boundary. May 25th U.S. midpoint. Same zone. That is the execution area. The stop sits at May 22nd U.S. session lower boundary. Why there? Because the long is using the May 22nd and May 21st memory stack. If price falls below May 22nd U.S. lower boundary, the overlapped midpoint support has failed. The compressed session can no longer protect the trade. The long has lost its base. So the stop belongs under that memory. Not at a random candle low. Not at a place that feels comfortable. At the line where the idea breaks. If price reaches that stop, the long is no longer the same trade. The target sits at April 27th U.S. session lower boundary. That is where price already tested. It is the next old memory above. If price holds the entry zone and builds distance, April 27th U.S. lower boundary becomes the clean target. Risk-reward ratio, 2.07. Now this is different from the first setup. The first long had 1.58. This one has 2.07. The ratio is better. But the environment is not automatically easier. Why? Because price already tested April 27th U.S. lower boundary and failed to stay free. That failure matters. A second attempt can work, but it must show stronger holding. If price enters from the midpoint and cannot move away, do not force it. If price holds the midpoint and reaction becomes slower, the long can build. If price reaches April 27th again and stalls, take the trade seriously. Do not expect unlimited continuation. Now the bearish candle matters. After the push, price falls back below May 22nd U.S. upper boundary. The candle moves with force. It returns into the session box. That is a warning. When a candle breaks back into the box, with more range than the basis box itself, the market is not calm. The move can be powerful. It can also make late entries dangerous. That is why the long must be taken only near the entry line, not after price runs, not after the target is close, not after the chart already looks obvious. Now, aggressive trader and conservative trader must choose differently. An aggressive trader may place a tighter stop. The stop distance becomes smaller. Position size becomes larger. The ratio becomes attractive. Sometimes price never touches the tight stop. The trade pays. But the danger is simple. A tight stop can be hit by normal rotation, especially inside a 30% compressed box. The idea can still be right, but the position can disappear. A conservative trader allows more room. The stop goes under stronger memory. The size becomes smaller. The trade survives more noise. But the reward must still justify the risk. If the wider stop weakens the ratio too much, skip the trade. Conservative trading is not only wider stops. Sometimes it is no trade. Now trailing. If price reaches the first target and keeps holding, the target can move, but the trail must be earned. Do not trail because you want more. Trail because price creates more. Use distance. A practical trailing interval should wait for about 0.5 risk-reward unit or more. That gives the position room. It reduces noise. When you move the target, move the stop. If the stop stays behind, profit stays exposed. If the stop comes too close, normal reaction removes the trade. So again, The stop follows structure. Partial profit helps when the reaction changes. If price reaches the target and reaction speeds up, a conservative trader protects more first. 60% first. 40% left for continuation. If price keeps holding and distance grows, an aggressive trader can leave more open. 40% first. 60% for continuation. For two stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But again, numbers do not replace structure. They only manage structure. Now connect the May 25th U.S. setup. The session forms near May 22nd U.S. midpoint. It compresses to 30%. It pushes toward April 27th U.S. lower boundary. It fails to stay free. It drops back below May 22nd U.S. upper boundary. It returns into the compressed box. The long can still exist, but only if May 21st U.S. upper boundary and May 25th U.S. midpoint hold. Entry: May 21st U.S. upper boundary. Stop: May 22nd U.S. lower boundary. Target: April 27th U.S. lower boundary. Risk-reward ratio: 2.07. The setup is not a chase. It is a test of overlap. The midpoint must hold. Old memory must support. Distance must open. If price only rotates, no trade. If price holds and moves away, the long becomes active. That is the lesson of the day. May 24th, Asia gives a wide box. May 25th, US gives a tight box. One expands. One compresses. Both require the same rule. Price reaches. It reacts. It holds or fails. Then the trader asks one more thing. Does the risk deserve the reward? Price drops first, but it does not stay down. The session forms inside the same memory. May 25th Asia session forms almost exactly inside the May 22nd US session box. It overlaps. It repeats the same space. It does not open a new clean range. That matters. When a session forms almost identical to an older session box, the market is not free. It is returning to the same fight. The same upper side matters. The same lower side matters. The same midpoint matters. The trade does not begin from direction. It begins from where price fails inside that memory. May 25th Asia session first moves down. It reaches toward the May 21st US session lower boundary. That level is old memory. It is where price must either continue lower or stop falling. The move looks bearish. But the first move is not enough. A short needs entry, a stop, a target, a reason. Then price reacts. It does not collapse freely. It moves back up. It reaches toward the May 22nd US session upper boundary. Now the whole range becomes clear. Price is moving between the May 21st US lower boundary and the May 22nd US upper boundary. The session is not giving trend. It is giving rotation. The short appears first. Short entry line. May 25th Asia session midpoint. Stop loss line. May 22nd US session upper boundary. Take profit line. May 21st US session lower boundary. Risk-reward ratio: 2.44. The midpoint becomes the short entry because price is trading inside overlapping memory. When the session overlaps almost exactly with the May 22nd US box, the midpoint becomes the decision line. Above it, buyers can keep the rotation alive. Below it, sellers can push price back toward the lower memory. So the short does not come from chasing the first drop. It comes from the midpoint failing. Price reaches the midpoint. It reacts. It cannot stay above. It returns lower. Now the short has structure. The stop sits at the May 22nd U.S. session upper boundary. That line matters because the short uses the midpoint failure. If price climbs back to the May 22nd U.S. upper boundary, the short has lost control. The market has reclaimed the upper side of the overlapped box. The short is no longer clean, so the stop belongs there. Not because it feels comfortable, because the structure changes there. The target sits at the May 21st U.S. session lower boundary. That target connects to the downside memory already tested. Price moved down there before. If the midpoint fails again, that lower boundary becomes the next place where price can complete the rotation. The risk-reward ratio is 2.44. That is clean enough to consider, but it still needs behavior. Price must fail the midpoint. Distance must open. Reaction must not come back too fast. If price crosses the midpoint and immediately returns above it, there is no short. If price moves below it and builds distance, the short becomes active. Now the next setup appears. Price reaches the May 21st U.S. lower boundary. It tests that lower memory. It does not continue smoothly. The downside begins to slow. Distance becomes shorter. Reaction starts to come back. Now the long can form. Long entry line. May 21st U.S. session lower boundary. Stop loss line. April 21st U.S. session upper boundary. Take profit line. May 22nd U.S. session upper boundary. Risk-reward ratio. 2.24. The long is not a random reversal. It forms because the lower boundary holds. Price already traveled from the midpoint area down into older memory. If sellers had full control, price should break lower and stay lower. It should move through the May 21st U.S. lower boundary and create distance. But it does not. It reacts. It returns. That holding attempt creates the long. The entry sits at the May 21st U.S. lower boundary because that is where downside movement must prove continuation. If price cannot stay below that lower boundary, the short rotation has completed. The next move can rotate back up toward May 22nd U.S. upper memory. The stop sits at the April 21st U.S. session upper boundary. That stop is deeper. Why not tighter? Because lower memory can create noise. If the stop is placed too close under the May 21st U.S. lower boundary, normal reaction can touch it before the real move begins. Then price can still rotate up, but the position is gone. That is the pain of tight stops. A tighter stop can improve the visible ratio. It can allow bigger size. It can look cleaner, but it can also remove the trade before the target. So the stop must protect the structure. Not comfort, not greed, not the desire for a bigger position. The target sits at the May 22nd U.S. session upper boundary. That is the top side of the same working range. If price holds the May 21st U.S. lower boundary and rotates back up, that upper boundary is the clean target. The same memory creates both trades. First, the midpoint fails. Short to lower memory. Then lower memory holds. Long to upper memory. Same box. Opposite direction. Different behavior. That is why direction alone is not enough. You do not say short all day. You do not say long all day. You trade the line that holds or fails. Now the trader type matters. An aggressive trader may use a tight stop. The stop distance becomes smaller. The position size can become larger. Sometimes price never touches the tight stop. The trade pays fast. But the cost is real. Normal reaction can hit the stop. The trade idea can remain right. The account cannot collect. A conservative trader gives the trade more room. The stop is not too tight. The size becomes smaller. The position survives more noise. But the reward must still deserve the risk. If the wider stop makes the ratio too weak, the answer can be no trade. That is not fear. That is selection. Now, trailing. Trailing does not begin because the trader wants more. Trailing begins when price earns more distance. A practical trailing interval needs at least about 0.5 risk-reward unit of additional movement. Less than that can be noise. If you trail too early, normal reaction removes the position. If you trail too late, the trade gives back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot become too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far behind, the trail protects nothing. So the stop follows structure, not emotion, not the last candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price holds the target and distance keeps growing, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But percentages do not create edge. They only manage a trade that already has structure. May 25th Asia gives the lesson clearly. The session overlaps the May 22nd US box. The midpoint gives the short. The May 21st US lower boundary gives the long. The same memory flips the trade. Price reaches. It reacts. It holds or fails. Then the position appears. Price pushes up again. But the higher test does not stay free. The session forms inside compressed memory. May 26th US session forms near the midpoint of the May 21st US session box. It compresses by about 50%. It overlaps there. That matters. A compressed session can move fast. But fast movement does not always give clean direction. The box is smaller. The decision comes sooner. The reaction can also come sooner. May 26th US session first moves up. It reaches the April 27th US session lower boundary. That level has already mattered many times. It is old memory. It is not just another line. If price can reclaim it and hold above it, the long can continue. If price reaches it and cannot stay, the move can flip hard. Price reaches. It tests. It reacts. Then price drops. It breaks below the May 21st US session upper boundary. It continues lower. It tries to reach the April 20th US session upper boundary. It cannot fully test it. That matters. The drop is strong. But the lower target is not reached cleanly. So the trader must separate two things. The first trade is the long from the lower side. The second trade is the short after the higher failure. They are not the same decision. First setup. Long entry line. May 26th US session lower boundary. Stop loss line. April 21st US session upper boundary. Take profit line. May 25th US session upper boundary. Trailing target. April 27th US session lower boundary. Risk-reward ratio 2.03. The long entry sits at the May 26th US lower boundary. Why there? Because the session forms compressed near May 21st US midpoint. The lower boundary becomes the place where buyers must defend the compressed session. If price holds that lower boundary and starts moving away, the long can build. If price loses it, there is no long. The stop sits at the April 21st US session upper boundary. That is deeper memory. It gives the trade room. If price falls through that old memory, the long has lost its base. The compressed session is no longer protecting the position. The trade is damaged. The target sits at the May 25th U.S. session upper boundary. That is the first nearby memory above. If the lower boundary holds, the first clean push can aim there. Then the trailing target sits at the April 27th U.S. session lower boundary. That is the higher memory where price later tests. Risk-reward ratio 2.03. The ratio is acceptable. But the long must be taken near the lower boundary. If the trader enters late, near the first target, the ratio breaks. If the stop is widened without reason, the ratio breaks. If the target is moved higher before price earns distance, the trade becomes hope. So the long needs discipline. Price must hold the lower boundary. Distance must open. Reaction must slow. Then the trade can work. But then comes the higher test. Price reaches the April 27th U.S. session lower boundary. It cannot stay free. Now the short appears. Additional short entry line. April 27th U.S. session lower boundary. Stop loss line. April 27th U.S. session upper boundary. Take profit line. May 25th U.S. session lower boundary. First trailing target. May 26th U.S. session lower boundary. Second trailing target. May 21st U.S. session lower boundary. Risk-reward ratio 4.49. This is the stronger setup. The short entry sits at the April 27th U.S. lower boundary because price already tested that memory and failed to hold above it. If price reclaims April 27th U.S. lower boundary and keeps distance, the long can continue. But if price reaches that boundary and fails, the move flips. The lower boundary becomes the trap line. Price touches. It reacts. It cannot stay. Then sellers take control. That is the short. The stop sits at the April 27th U.S. upper boundary. If price recovers to that upper boundary, the short has lost the failure. The market has returned too far into April 27th memory. The short no longer controls the structure. So the stop belongs there. It may feel wide, but the target also opens. The first target is the May 25th U.S. lower boundary. That is where price can return after the April 27th failure. The first trailing target is the May 26th U.S. lower boundary. If price breaks lower and holds distance, the short can press into the active session base. The second trailing target is the May 21st U.S. lower boundary. That creates the larger return. Risk-reward ratio 4.49. That is why the second trade is more attractive. The long was valid, but the short after failure gives stronger reward. Still, the number alone is not the trade. Price must fail the April 27th lower boundary. It must move away. It must not reclaim quickly. If it only wicks below and comes back, there is no short. If it loses the line and opens distance, the short becomes active. Now stop style matters again. An aggressive trader may tighten the stop. The ratio improves. Position size can increase. Sometimes this works. But a tight stop inside old memory can be dangerous. April 27th memory can create reaction. Price can move up, touch the stop, then fall. The idea can be correct. The position can be gone. A conservative trader places the stop where the idea truly fails. The size becomes smaller. The trade survives more noise. But the reward must still justify the risk. Here, the reward is strong enough to study. Risk-reward ratio 4.49. That gives room. Now trailing matters. After the short reaches the first target, do not assume the second target. Price must earn it. If price reaches May 25th U.S. lower boundary and stalls, protect the trade. If price breaks and holds below, trail toward May 26th U.S. lower boundary. If price continues lower and fails to reclaim, trail toward May 21st U.S. lower boundary. The trailing interval should not be random. Use at least about 0.5 risk-reward unit of additional distance as a practical guide. If the move has not earned that distance, the trail may be too early. If it has earned that distance and the stop is still far away, the trade is exposed. When the target moves, the stop follows. But the stop follows structure. Not the last red candle. Not fear. Not excitement. Partial profit can help. A conservative trader can protect more at the first target. 60% first. 40% left. An aggressive trader can leave more for the second and third targets. 40% first. 60% left. With two trailing stages, a conservative trader can take 50%, 30%, 20%. A balanced trader can take 25%, 50%, 25%. An aggressive trader can take 20%, 30%, 50%. But the percentages only matter after the trade has earned structure. They do not fix bad entry. They do not fix late chasing. They do not fix unclear failure. Now, connect the day. May 26th U.S. forms compressed near May 21st U.S. midpoint. Price moves up to April 27th U.S. lower boundary. That is the first major test. A long can form from the May 26th U.S. lower boundary if buyers defend the compressed box. But after the April 27th test fails, the larger short appears. The short uses April 27th U.S. lower boundary as entry, April 27th U.S. upper boundary as stop, May 25th U.S. lower boundary as target, then May 26th U.S. lower boundary as first trail, then May 21st U.S. lower boundary as second trail. Risk-reward ratio 4.49. That is the key. The first trade is valid. The second trade is stronger. But both require the same rule. Price reaches. It reacts. It holds or fails. Monthly, weekly, and daily charts explain why the movement looks violent. The intraday chart is not moving in empty space. It is rotating inside a larger memory. If today's movement feels confusing, step back. Look at the monthly chart. Look at the weekly chart. Look at the daily chart. The large time frame shows the pressure. The 1-hour chart shows the execution. Every day's entry and every response after entry becomes clearer when those frames align. The method stays the same. Higher time frame gives location. Session memory gives execution. Risk decides survival. Price drops first, but it cannot stay low. The session forms inside wide memory. May 26th Asia session forms with a similar size to April 21st U.S. session box. It overlaps that older memory. It does not form as a small, clean box. It forms wide. That matters. A wide session gives space. But that space is not always strong. Wide support protects across a broad area. But the line is weaker. Wide resistance blocks across a broad area. But the reaction can be messy. Narrow support can be tighter. Narrow resistance can be stronger. That is why box width matters. May 26th Asia session forms with enough width to create movement inside the box. Price first stays inside May 26th Asia session box. It rotates. It moves down. It does not immediately expand. It does not create clean direction. Then price reaches April 20th U.S. session upper boundary. That is the first important test. Price moves down into that old memory. It touches. It reacts. It cannot keep falling. The downside loses control there. That is where the long starts to appear. Not because price is already strong. Because sellers fail at an older boundary. That matters. The long is not a chase. The long is a response to failed downside pressure. Now price begins to move up. It returns through the structure. It pushes toward April 21st U.S. session upper boundary. That becomes the target. The move is not random. It starts from April 20th U.S. upper memory. It aims toward April 21st U.S. upper memory. Old session memory gives both sides. Entry. Stop. Target. That is how the trade becomes visible. Long entry line. April 20th U.S. session upper boundary. Stop loss line. April 20th U.S. session midpoint. Take profit line. April 21st U.S. session upper boundary. Risk-reward ratio. 2.48. The entry sits at April 20th U.S. session upper boundary. Why there? Because price drops into that line and cannot stay below it. If price had broken below it and kept distance, there would be no long. If price had moved sideways without reaction, there would be no clean entry. But price reaches the line. It reacts. It starts to move away. That creates the long. The stop sits at April 20th U.S. session midpoint. Why there? Because the long uses April 20th U.S. upper boundary as support. If price returns all the way back to April 20th U.S. midpoint, the upper boundary hold has already weakened. The trade has lost too much control. The move has returned into balance. That is where the long idea is damaged. So the midpoint becomes the stop line, not because it feels close, not because it improves the ratio, because the structure changes there. If price reaches the midpoint, the long no longer has the same reason to exist. You leave. No argument. No hoping for one more bounce. The target sits at April 21st U.S. session upper boundary. That is where the move can complete. Price is moving from one old U.S. memory toward another old U.S. memory. That is the structure. The target is not chosen because it looks far. It is chosen because price has a reason to react there. If price reaches that boundary and stalls, the trade has paid. If price reaches that boundary and keeps distance, a trail can be studied. But the first job is simple. Take the clean target. Do not turn every long into a trend prediction. Now look at the risk-reward. 2.48. That is usable. That gives the trade room. The reward is large enough to justify the stop. The entry is not too late. The stop is not too deep. The target connects to old memory. Those three lines fit together. That is why the trade can be executed. Now compare trader types. An aggressive trader may tighten the stop. The stop distance becomes smaller. Position size can become larger. Sometimes price never touches that tighter stop. The trade pays faster, but the danger stays real. A tight stop can be touched by normal reaction. The direction can be right. The position can be gone. That is painful. You read the structure correctly, but you cannot collect the move. A conservative trader gives the structure more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. The chance of losing the position before the target decreases. But the wider stop must still pass. The risk-reward test. If the wider stop destroys the ratio, the conservative answer can become no trade. That is not weakness. That is account protection. Now trailing. Trailing is not automatic. A trade must earn the trail. If price reaches the first target and stalls, take the result. If price reaches the first target and holds with distance, the remaining position can be managed. A practical trailing interval needs space. About 0.5 risk-reward unit or more is a useful minimum. Less than that often becomes noise. If you trail too early, you suffocate the position. If you trail too late, you give back too much. When the target moves, The stop must move too. A target that moves without a stop is only hope. But the stop cannot sit too close. If normal reaction touches it, the trail damages the trade. If the stop stays too far away, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last green candle. Partial profit can help. If price reaches the first target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price keeps holding distance, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But numbers do not create the trade. They only manage a trade that already has structure. May 26th, Asia gives the clean lesson. The session is wide. The support is wide. The reaction must prove itself. Price reaches April 20th U.S. upper boundary. It cannot keep falling. It returns. The long forms. The stop sits at April 20th U.S. midpoint. The target sits at April 21st U.S. upper boundary. Risk-reward ratio 2.48. The trade works because old memory holds. The move pays because the target is real. The entry comes before the obvious recovery. Price reaches. It reacts. It holds. Then the long begins. Price holds the lower side, but the trade still fails the test. The session forms inside expanded weak memory. May 27th U.S. session forms almost aligned with May 26th Asia session lower boundary. It expands to about 200% of April 20th U.S. session box. It overlaps. It forms wide. That matters. A wide box gives wide movement. But wide movement does not always give clean execution. The lower memory underneath is too spread out. Support is not tight. Reaction can move deeply. A stop needs more room. A target needs more time. That is where the problem starts. May 27th U.S. session tests its own lower boundary. Price moves around the lower side. It stays inside the box. It does not leave with clean direction. It touches. It reacts. It returns. It does not build stable distance. A long setup can be drawn, but drawing a setup is not enough. The trade still needs quality. Long entry line. May 27th U.S. session lower boundary. Stop-loss line. May 27th U.S. session lower boundary. Minus 125% area. Take profit line. May 27th U.S. session midpoint. Risk-reward ratio 1.8. At first, the trade looks possible. The number is not terrible. The line is visible. The target is clear. The lower boundary gets tested. So the hand wants to enter. But the structure is not clean enough. The entry sits at May 27th U.S. session lower boundary. That can work only if price holds there and moves away. If price only rides the boundary, the long becomes weak. If price cannot create distance, the trade becomes slow. If reaction comes back fast, the stop comes under pressure. This is where the chart starts warning us. The lower support area is too wide. The old session memories below are not tight enough. There is too much empty distance between meaningful supports. That changes the stop. If we want a safe stop, the stop must sit deep. But a deep stop changes the trade. The risk becomes larger. The position size must become smaller. The target must move higher to keep the ratio alive. And when the target moves higher, the trade needs more time. More time means more exposure. More exposure means more risk. The trade may not lose immediately, but the account stays under pressure longer. That matters. A trade can look good on the line, but bad in time. A target too high can trap the trader inside waiting. The position stays open. Reaction keeps coming. Price rotates. The trader loses patience. Then the trade becomes emotional. That is why this long should be skipped. Not because the entry is impossible. Because the full structure is not good enough. The stop is too deep if we protect the real structure. The target becomes too high if we force the ratio. The time risk becomes too long if price moves slowly. That is not clean execution. That is forcing a trade. Now look at the session width again. Wide session boxes create weaker support and resistance. The boundary is not sharp. Price can move around it. It can pierce. It can return. It can test again. That makes the stop harder. A narrow box gives a tighter decision. Price either holds the line or fails quickly. A wide box gives a broader fight. That can be useful for larger trades, but it can be dangerous for 1-hour execution. May 27th U.S. session is that kind of danger. It looks tradable, but the support under it is too wide. The reward does not compensate enough. The time pressure is not favorable. So the better decision is no trade. Now compare aggressive and conservative behavior. An aggressive trader may still enter. They may tighten the stop. They may increase size because the stop distance is smaller. Sometimes price never touches that stop. The trade can pay, but the danger is clear. A tight stop inside a wide box can be meaningless. Normal rotation can touch it. The trade can still be right later, but the position is gone. That is not structure. That is impatience with a small stop. A conservative trader looks deeper. They ask where the structure actually fails. They place the stop below the true support area. Then the risk becomes too large. The target must become too high. The waiting time grows. So the conservative trader skips. That is the better answer here. No trade protects the account. No trade protects the next opportunity. No trade protects the method. Now, trailing does not matter if the trade should not start. That is important. Many traders want to solve a weak entry with clever management. But management cannot fix a bad trade selection. If the entry is weak, the trail cannot save it. If the stop is too deep, partial profit cannot fix it. If the target needs too much time, a nice plan cannot remove exposure. The decision must happen before entry. Does the line hold? Does the stop make sense? Does the target pay? Does the trade have time? Here, the answer is not clean. So we wait. Now connect the movement. May 27th U.S. session forms wide. Near May 26th, Asia lower boundary. It tests the lower side. It stays inside the box. It offers a visible long. Entry. May 27th U.S. lower boundary. Stop. May 27th U.S. lower boundary. Minus 125%. Target. May 27th U.S. midpoint. Risk-reward ratio. 1.8. But the support below is too wide. The safe stop becomes too deep. The target becomes too high. The trade may need too much time, so the trade is skipped. That is the main lesson. A visible setup is not always a tradable setup. A risk-reward number is not always enough. A line can hold and still not deserve entry. Now the larger charts matter. If this movement is confusing, go back to monthly, weekly, and daily structure, especially the weekly chart. The weekly chart must be visible before every serious trade. The 1-hour chart gives the entry. But the weekly chart tells you where the market is trapped. It tells you whether price has room. It tells you whether the target is realistic. It tells you whether the trade is fighting a larger boundary. Monthly gives the field. Weekly gives the pressure. Daily gives the working range. 1 hour gives execution. If the 1-hour setup looks unclear, the answer is not to force a trade. The answer is to step back. Look at the larger boxes. Look at where price is sitting. Look at whether the next target has space. Look at whether the stop is too deep. That is how daily movement becomes understandable. And that is why weekly analysis matters. The daily chart can show the rhythm. The weekly chart can show the wall. The monthly chart can show the battlefield. When those frames align, the 1-hour trade becomes cleaner. When they do not align, no trade often becomes the best trade. May 26th gives one clean long. May 27th gives one tempting long. The first one works because risk and reward align. The second one should be skipped because the box is too wide and time becomes risk. Same market, different quality. Price reaches. It reacts. It holds or fails. Then the trader asks the final question: does the risk deserve the reward? Price drops hard, but the drop was already prepared. The session forms inside wide old memory. Before the 1-hour trade, we check the higher time frame. Monthly, weekly, daily, especially the weekly chart. You need that map before the entry. The 1-hour chart gives the execution, but the higher time frame tells you where the market is trapped. If you ignore that, you enter late. You chase the move. You hold when the target is already finished. You place the stop where noise can reach it. That is why the bigger chart comes first. Now move into the 1-hour structure. May 27th Asia session forms between April 16th U.S. session midpoint and April 16th U.S. session upper boundary. It overlaps that old structure. It forms inside memory. That matters. Session overlap matters. Session compression matters. Session expansion matters. Every box gives a different kind of pressure. A wide session box gives wide support. But wide support is not always strong. It can absorb price across a broad area. It can also let price travel too far. The line is not sharp. The reaction can be messy. A narrow session box gives narrow support, but narrow support can be stronger. The decision comes faster. The reaction becomes clearer. That difference matters today. Yesterday, the wide April 16th U.S. session box was already important. If you watched it carefully, you knew the next session could move inside that wide space. You also knew the support below could be weak, not empty, but wide. That means price can fall deeper before the structure reacts. That is the setup. May 27th Asia session continues inside May 26th Asia session box. Price does not start with clean expansion. It stays inside the previous range. It moves. It stalls. It returns. Then the downside starts to open. Price drops hard. It reaches April 16th U.S. session lower boundary. That is the target area. The drop does not appear from nowhere. It moves from one compressed decision area toward a wider old memory line. Now the trade becomes clear. Short entry line. May 27th, Asia session lower boundary. Stop loss line. May 27th, U.S. session lower boundary. Take profit line. April 16th, U.S. session lower boundary. Risk-reward ratio, 1.98. The short entry sits at May 27th, Asia session lower boundary. Why there? Because the session had been moving inside prior memory. The lower boundary becomes the line where the session loses control. If price breaks below that lower boundary and cannot reclaim it, sellers take the next move. The short does not start because the candle is red. It starts because the lower boundary fails. That is the difference. A red candle can be late. A failed boundary can become entry. Price reaches the lower boundary. It reacts. It cannot hold above it. Then distance opens downward. That is where the short becomes valid. The stop sits at May 27th U.S. session, lower boundary. Why there? Because that line is the higher nearby memory that can damage the short. If price returns there, the downside pressure is no longer clean. Price has reclaimed too much. The short has lost control. The stop is not a random safety line. It is the line where the idea changes. If price gets there, the short is no longer the same trade. You leave. No hope. No waiting for one more candle. The target sits at April 16th U.S. session lower boundary. Why there? Because April 16th U.S. box is wide, and the lower boundary is the next major old memory. The drop is not aimed into empty space. It is moving toward the bottom of the wider old box. That gives the short a real objective. If price reaches that line and reacts, the trade is paid. If price reaches it and stalls, protect. If price breaks through and holds lower, only then can continuation be studied. Risk-reward ratio is 1.98, close to 2. Usable, but not automatic. The trade needs clean entry. If you enter late after the drop already runs, the ratio breaks. If you widen the stop after entry, the ratio breaks. If you hope for a lower target without structure, the trade becomes emotional. So execution must be clean. Entry at the line. Stop at the damage point. Target at old memory. Now stop style matters. An aggressive trader can use a tighter stop. The stop distance becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tighter stop. The short pays. But that advantage has a cost. A tight stop can be touched by normal reaction. The direction can be right. The position can still be gone. You can understand the move. You can still fail the trade. That is the pain of tight stops. A conservative trader does not place the stop too tight. The stop gives the structure more room. The position size becomes smaller. The trade survives more noise. The chance of being removed before the target decreases. But the wider stop must still allow a good ratio. If the reward cannot pay for the deeper stop, the better decision can be no trade. That matters. Conservative trading does not always mean wider stop. Sometimes conservative trading means skipping the trade. Now trailing. A trade must earn the trail. A target should not move because you want more. It moves only after price creates more distance. A useful trailing interval needs space. About 0.5 risk-reward unit or more is a practical minimum. Less than that often becomes noise. If you trail too early, you suffocate the position. If you trail too late, you give back too much. When the target moves, the stop must move too. A target that moves without a stop is only hope. But the stop cannot be too tight. If normal reaction touches it, the trail damages the trade. If the stop stays too far away, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last red candle. Partial profit can help. If price reaches the target and reaction starts to speed up, protect more first. A conservative trader can take 60% first and leave 40% for continuation. If price keeps distance and pullbacks stay shallow, an aggressive trader can leave more open. An aggressive trader can take 40% first and leave 60% for continuation. If there are two trailing stages, the same logic continues. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But numbers do not create the trade. They only manage a trade that already has structure. Now return to the chart. May 27th Asia forms inside April 16th US memory. It continues inside May 26th Asia structure. Price loses the lower boundary. It drops toward April 16th US lower boundary. The short works because the lower boundary fails. The stop works because the reclaim point is clear. The target works because old memory is waiting below. That is the trade. Not prediction. Not emotion. Price reaches. It reacts. It fails to hold. Then the short begins. Price stops falling. But the long still needs proof. The session forms at compressed lower memory. May 28th US session forms at April 16th US session lower boundary. It compresses by about 50%. It overlaps there. That matters. Now the market is not dealing with the wide middle anymore. It is dealing with the lower edge. The lower edge has already been tested. Price has already fallen into old memory. Now the question changes. Can that lower memory hold? If it holds, a long can form. If it fails, the downside continues. May 28th US session forms tight compared with the wide April 16th structure. That gives a clearer decision. Narrower compression can create stronger reaction, but it still needs proof. The market does not pay for guessing. Price begins to move inside May 28th US session basis box. It tests the structure. It rotates. Then price pushes toward May 28th US session upper boundary. That becomes the target area. The long setup appears. Long entry line. May 28th US session lower boundary. Stop loss line. April 10th US session midpoint. Take profit line. May 28th US session upper boundary. Risk-reward ratio 1.69. The entry sits at May 28th US session lower boundary. Why there? Because the session forms at April 16th US lower memory. The lower boundary becomes the place where buyers must defend. If price touches that lower boundary and immediately loses it, there is no long. If price holds there and starts moving away, the long becomes possible. The long is not based on a bullish feeling. It is based on failed downside continuation. Sellers pushed into old memory. Price stopped. The lower boundary held. Distance started to open. That creates the long. The stop sits at April 10th US session midpoint. Why there? Because the support below is still wide. If we place the stop too close, normal reaction can touch it. A tight stop can improve the visible ratio, but it may not protect the structure. It may only protect comfort. The April 10th U.S. midpoint gives deeper protection. If price falls that far, the lower memory has failed. The long has lost its base. That is where the idea changes. So the stop belongs there, not because it is pleasant, because the structure needs room. The target sits at May 28th U.S. session upper boundary. Why there? Because the trade starts at the lower side of the active session box. If price holds the lower boundary and moves away, the upper boundary is the first clean completion point. The target is not far. It is not dramatic. It is realistic. That matters. Risk-reward ratio is 1.69. It is acceptable only if entry is clean. If you enter late near the middle, the ratio weakens. If you widen the stop after entry, the ratio weakens. If you raise the target without proof, the trade becomes hope. So the long must begin at the lower line. Not after price already reaches the upper side. Now the box width rule appears again. A wide box gives broad, weak support. A narrow box gives tight, strong decision. May 28th U.S. session is compressed. That helps. But the larger April 16th U.S. structure below is still wide. So the trade has two layers. The local session gives a tighter entry. The old, wider memory demands a deeper stop. That tension creates the risk. If you only look at May 28th U.S. box, the long looks simple. If you include April 16th and April 10th memory, the stop becomes more serious. That is why higher time frame and older session memory matter. You must know what sits below. You must know what can break. You must know where the trade is actually wrong. Now compare aggressive and conservative traders. An aggressive trader may tighten the stop. The stop distance becomes smaller. The position size becomes larger. Sometimes price never touches that tighter stop. The trade pays quickly. But if the market rotates one more time, the stop can be touched before the real move. Then the trade may later reach target without you. That is not bad luck. That is the cost of aggression. A conservative trader gives the trade more room. The stop is deeper. The position size is smaller. The trade survives more rotation. But the risk-reward must still work. If the deeper stop makes the trade too weak, skip. Do not force a long just because lower memory reacts. Reaction is not enough. Holding is required. Distance is required. Reward is required. Now trailing. This setup does not need forced trailing. The target is the upper boundary. If price reaches it and stalls, take the trade. If price breaks above it and holds with distance, a trail can be studied. But the market must earn that. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that often becomes noise. When the target moves, the stop must move too. But the stop cannot suffocate the trade. If the stop moves too close, normal reaction removes the position. If the stop stays too far back, profit is exposed. The stop follows structure, not emotion. Partial profit can help when price reaches the first target and slows. A conservative trader can take 60% first and leave 40% for continuation. An aggressive trader can take 40% first and leave 60% if distance holds. For two stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But again, Percentages do not fix poor entry. They manage good structure only. Now, step back. If today's movement is not clear, look at the monthly chart. Look at the weekly chart. Look at the daily chart. Especially the weekly chart. The 1-hour chart gives entry, but weekly memory tells you whether the move has room. It tells you whether price is trapped. It tells you whether the target is realistic. It tells you when a long is only a bounce, inside larger pressure. Monthly gives the field. Weekly gives pressure. Daily gives the working range. 1 hour gives execution. If the 1-hour trade feels confusing, do not force the entry. Step back. Find the larger box. Find the nearest boundary. Find the next target. Find the real stop. Then decide. May 27th, Asia gave the short after the lower boundary failed. May 28th, US gives the long, only if the lower memory holds. One trade follows breakdown. The other follows failed continuation lower. They look different, but the method is the same. Price reaches. It reacts. It holds or fails. Then risk decides. The short had May 27th, Asia lower boundary. The long has May 28th, US lower boundary. The short targeted April 16th, US lower boundary. The long targets May 28th, US upper boundary. Different direction. Same execution. No prediction. Only structure. If price cannot stay below old memory, the long can form. If price cannot hold the lower boundary, the long disappears. The account does not need every move. It needs clean risk. That is the decision. Price reaches. It reacts. It either holds or fails. Then the trader asks the only question that matters. Does the risk deserve the reward? Price holds lower memory, but the first long is too weak. The session forms inside tight compression. Before any trade, higher time frame comes first. Monthly, weekly, daily, especially weekly. If you do not know the higher map, the 1-hour chart can trap you. You enter late. You chase the move. You place the stop where noise can reach it. You wait for a target that has no real space. So before this trade, the bigger chart must already be in your head. Now move into May 28th Asia session. May 28th Asia session forms above May 28th US session upper boundary. It forms with about 25% compression inside April 16th US session box. It is not wide. It is tight. It overlaps older memory. That matters. A wide session box gives wider support and resistance, but the support is spread out. The reaction can be slower. The stop can become deeper. A narrow session box gives tighter support and resistance. The line can be stronger. The reaction can come faster. But the trade also needs exact timing. May 28th Asia session forms in that tight condition. Price stays inside May 28th Asia session box. It moves inside the box. It tests. It reacts. It does not immediately break free. Then price tests. May 28th US session upper boundary. The level holds for a moment. A long idea appears. Long entry line. May 28th Asia session lower boundary. Stop loss line. May 28th US session midpoint. Take profit line. May 28th Asia session upper boundary. Risk-reward ratio. 1.1. That number matters. The trade may look possible. The lower boundary can hold. Price can move toward the upper boundary. The box is visible. The entry line is visible. The target line is visible. But the trade is still not good enough. A 1.1 risk-reward ratio does not deserve execution. The account cannot survive by taking weak reward again and again. One win does not fix bad structure. One good candle does not fix poor reward. If the stop is real, the target must pay. Here, the target does not pay enough. So the answer is simple. No entry. That is not fear. That is execution. A trader does not take every possible move. A trader takes the move where risk deserves the reward. Now watch what happens next. Price continues inside the session. The long that looked possible does not give enough reward. Then the market shows the better trade. May 28th Asia session later reaches its upper boundary. It tests the upper side. It cannot stay there. Distance becomes shorter. Reaction comes back faster. The upper side begins to fail. Now the short appears. Short entry line. May 28th Asia session upper boundary. Stop loss line. May 27th Asia session lower boundary. Take profit line. May 28th Asia session lower boundary. First trailing target. May 28th US session midpoint. Second trailing target. May 28th US session lower boundary. Third trailing target. April 10th US session upper boundary. Risk-reward ratio 5.83. Now the trade quality changes. The first long had 1.1. The short gives 5.83. Same chart, different quality. That is why direction alone is useless. The long looked tradable, but the reward was weak. The short came after the upper side failed. The reward became strong. The entry sits at May 28th Asia session upper boundary. Why there? Because price reaches the upper side and cannot stay above it. The market tests strength. Strength fails. The short begins from that failure. You are not shorting because price is red. You are shorting because buyers fail at the top of a tight compressed box. That difference matters. A red candle can be late. A failed upper hold gives structure. The stop sits at May 27th Asia session lower boundary. That may look strange at first, but the short needs room. May 28th Asia is tight. The failure happens at the upper side. If price can return above the failed area and move back into higher memory, the short loses control. The stop must sit where the short idea breaks, not where the trader feels comfortable. A tight stop can improve the number, but it can remove the position early. A deeper stop reduces size, but it gives the trade survival. This trade pays because the target path is clear. The first target is May 28th Asia session lower boundary. That is the return through the box. If price fails at the upper side, the lower side becomes the first completion area. Price moves down. It reaches the first target. The trade pays. But the move does not stop there. Now the trail begins. First trailing target. May 28th US session midpoint. The short has already earned distance. Now price can test the next old memory. If price reaches that midpoint and reacts fast, protect the trade. If price breaks through and keeps distance, the next target can open. Second trailing target. May 28th US session lower boundary. This is deeper old memory. Price moves from the tight Asia box into the wider US box. The short still has pressure, but it must keep distance. If pullbacks deepen, protect. If reaction speeds up, protect. If price keeps moving away, let the trail work. Third trailing target. April 10th US session upper boundary. That is a larger memory target. Price can reach it only if the downside pressure continues. That is why the stop must follow. A target that moves without a stop is only hope. The market already paid. The remaining position must protect profit. Trailing needs a real interval. Do not trail every small candle. A useful trailing move should usually wait for about 0.5 risk-reward unit or more. Less than that often becomes noise. If you trail too early, the position suffocates. If you trail too late, the account gives back too much. So the stop follows structure, not fear, not greed, not the last red candle. Now, trader type matters. An aggressive trader may use a tighter stop. The stop distance becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The short pays quickly. But the danger stays real. Normal reaction can touch the tight stop. The structure can still be right. The position can already be gone. A conservative trader gives more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. The chance of losing the position before the target decreases. But the wider stop must still pass the reward test. If the reward cannot pay, the trade is skipped. Partial profit can help. At the first target, a conservative trader can take 60% and leave 40%. An aggressive trader can take 40% and leave 60%. If the trail reaches multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the percentages do not create the edge. They only manage a trade that already has structure. May 28th, Asia gives the full lesson. The first long appears. The ratio is 1.1. It gets skipped. Then the upper side fails. The short appears. The ratio expands to 5.83. Price returns through the box. Then the trail moves through deeper memory. Same session. Different trade. The first setup tempts you. The second setup pays you. The difference is not direction. The difference is risk. Price reaches. It reacts. It fails to hold. Then the better trade begins. Price pushes up again, but the clock takes the trade away. The session forms inside compressed memory. May 29th U.S. session forms at May 28th U.S. session midpoint. It compresses by about 50%. It overlaps there. That matters. The box is not wide. The decision area is tighter. A narrow box can create stronger reaction, but it can also create a trap. The line looks clean. The trade looks easy. The hand wants to enter. But the session is the last session of the week. That changes everything. May 29th U.S. session first pushes higher. It breaks above May 28th Asia session upper boundary. Then it reaches May 27th Asia session lower boundary. The move looks alive. Price has lifted from the compressed area. It has reclaimed the Asia upper side. It has reached older memory above. A long setup appears. Long entry line. May 29th U.S. session midpoint. Stop loss line. May 28th U.S. session lower boundary. Take profit line. May 28th Asia session upper boundary. Risk-reward ratio 2.06. At first, this looks acceptable. The ratio is above 2. The entry line is clear. The stop line is clear. The target is realistic. But trading is not only numbers. The timing matters. May 29th U.S. session is the final session of the week. Safe trading needs time. A clean long needs space. A comfortable weekend needs less exposure. Here, the trade appears late in the weekly cycle. That changes the decision. The long entry sits at May 29th U.S. session midpoint. Why there? Because the session forms around May 28th U.S. midpoint. The midpoint becomes the decision line. If price holds above it, the long can push toward May 28th Asia upper boundary. If price loses it, the long has no base. So the entry logic is clear, but clear logic is not enough. The trade also needs enough time to move, react, and complete. The stop sits at May 28th U.S. session lower boundary. That stop protects the lower side of the prior session memory. If price falls below that boundary, the long has lost the compressed base. The structure has failed. The stop makes sense. The target sits at May 28th Asia session upper boundary. That target is the first clean old memory above. If price holds the midpoint and moves away, that target can pay. So why skip? Because the last session changes risk. There are fewer candles left. Management time becomes shorter. The market can stall. The trade can remain open too long. The trader can carry stress into the weekend. A valid trade can still be skipped when the timing is poor. That is execution, not weakness, not fear. Protection. Look at the behavior. Price breaks above May 28th Asia session upper boundary. It reaches May 27th Asia session lower boundary. But then the market does not open clean freedom. It pulls back. It rotates. It hesitates. Distance does not keep expanding. Continuation does not stay clean. The trade can still work, but it does not deserve forced entry. Now compare this with May 28th Asia short. The short had 5.83. The move had distance. The targets opened lower. The trade gave room to manage. May 29th U.S. long has 2.06. Usable. But the timing is weaker. The weekend is near. The room is less attractive. The trade requires holding into uncertainty. That is why the best position can be no trade. No trade is not empty. No trade protects the account. No trade protects the next week. No trade protects the method. A trader who skips weak timing still wins the process. Now think about aggressive traders. An aggressive trader may still enter. They may tighten the stop. They may use smaller time windows. They may try to capture the move before the week closes. That can work, but it requires fast management. If price does not move quickly, the position must be reduced. If price returns below the midpoint, the trade must be closed. If the target is not reached before time runs out, the trader must decide quickly. This is not a comfortable setup. A conservative trader does not need that pressure. The conservative trader skips, especially when the weekly session is ending, especially when the move has already tested older memory above, especially when the prior day already gave the better opportunity. That matters. You do not need every trade. You need the right trade. If the day already gave a 5.83 short, the next late long does not need to be forced. Protect the weak. Protect the capital. Protect the method. Now, trailing rules still matter, but only after a trade earns distance. If price reaches the first target and holds with strength, a trail can be considered. But here, the main decision is before entry. Does the setup deserve fresh risk? Does the weak allow time? Does the target give enough space? Does the stop protect structure? Does the trade create stress after the close? If the answer is unclear, skip. Trailing cannot fix bad timing. Partial profit cannot fix a forced entry. A good ratio cannot fix a final session problem. That is the lesson. Still, if an aggressive trader takes it, management must be strict. At the first target, protect quickly. A conservative style inside an aggressive trade can take 60% first and leave 40%. A more aggressive style can take 40% first and leave 60%, but only if the price moves quickly. If price stalls, do not pretend it is still clean. If there are two stages, do not wait for perfection. Take profit. Move the stop. Reduce exposure. The weekend does not give unlimited management time. Now step back. If today's movement feels confusing, move to the higher time frame. Monthly, weekly, daily, especially weekly. A 1-hour chart can show the entry, but the weekly chart shows the wall. The daily chart shows the working range. The monthly chart shows the field. If the 1-hour long looks tempting, but the weekly chart gives no space, do not force it. If the 1-hour short looks strong, but the daily chart sits on support, watch reaction. If the session is late and the box is compressed, be more selective. That is why the weekly review matters. Without it, the trader sees only candles. With it, the trader sees where the candles are trapped. May 29th U.S. session gives a visible long. Entry. May 29th U.S. midpoint. Stop. May 28th U.S. lower boundary. Target. May 28th Asia upper boundary. Risk-reward ratio. 2.06. But the final session makes the answer different. The cleanest position is no trade, because time is risk. Weekend is risk. A late entry is risk. The setup may work, but the account does not need it. May 28th Asia gave the better short. May 29th US gives the tempting long. One pays. One should be skipped. That is the day. Price reaches. It reacts. It holds or fails. Then the trader asks the final question. Does the trade deserve risk now? The 1-hour chart showed the fight. Now the bigger chart shows why the fight repeated. Fast candles can hide the real pressure. A 1-hour breakout can feel strong. But if the daily chart is pressing into an old upper boundary, the move can stop early. A 1-hour short can look late. But if the weekly chart has already lost a major memory line, the downside can keep pulling. A 1-hour no trade can feel boring. But if the monthly chart is fighting a major boundary, waiting can be the cleanest position. So now we step back. Not to explain after the fact. To locate the next risk. The daily chart gives the working range. The weekly chart gives the pressure. The monthly chart gives the field. Together they show why the 1-hour trades had to be managed quickly. This week was not moving in empty space. It moved under daily resistance. It moved below weekly failed memory. It moved around monthly confirmation pressure. That is why holding blindly was dangerous. That is why targets mattered. That is why stop placement mattered. That is why no trade was sometimes stronger than entry. Now we read the large structure the same way. Location. Reach. Reaction. Failure. Return. If the daily chart cannot hold above its upper memory, long continuation stays limited. If the weekly chart cannot reclaim the lost box, short pressure stays alive. If the monthly chart cannot stay above the 2026 lower boundary, the larger structure still refuses confirmation. Next week starts from those questions. Not from opinion. Not from bullish or bearish feelings. From the line. Can price reclaim? Can price hold? Can price build distance? If it can, the long can form. If it cannot, the short can form. If it rotates, the account waits. Price breaks higher. But the daily chart refuses acceptance. The May 1st daily basis box forms inside the February 1st daily basis box. It is only slightly compressed. It overlaps. That matters. May does not start far away from February memory. May starts inside it. The February 1st daily upper boundary and the May 1st daily upper boundary almost match. That same area sits near the weekly 0.5 area. That creates a heavy decision zone. Price can break above it, but price must stay above it. A break without holding is not freedom. A touch without distance is not confirmation. A candle above the line is not enough. Price first moves up. It breaks above the February 1st daily basis box upper boundary. The move looks strong. The chart gives the feeling of breakout. But the next step fails. Price tries to move toward the December 1st daily basis box lower boundary. It cannot even test that level cleanly. It fails before the test. That matters. When price cannot even reach the next higher memory, continuation is already weak. Distance becomes shorter. Pullbacks deepen. Reaction comes faster. The daily chart starts warning the 1-hour trader. Do not chase late longs. Do not assume the breakout is free. Do not move the target higher unless price earns it. Then price returns to the May 1st daily upper boundary. It tests that upper area several times. It tries to stay. It cannot settle safely. The same line keeps rejecting clean acceptance. That is the real story of the week. Price moves above. It cannot stay. It returns. Then the daily chart falls back inside the May 1st daily basis box. Now the working range changes. The market is no longer trading above the box. It is trading inside the box again. That changes the 1-hour plan. A long near the upper boundary becomes late. A short after failed acceptance becomes more reasonable. A long near the lower boundary still needs proof. Everything depends on whether price holds or fails at the line. After the upper failure, price moves lower. It tests the May 1st daily basis box lower boundary. Then it also starts testing the February 1st daily basis box lower boundary. Now the daily chart is not asking for breakout continuation. It is asking whether lower memory can hold. If May lower boundary holds, the structure can rotate. If February lower boundary fails, the downside can open again. That is why 1-hour trades during the week needed strict management. Some longs could work, but they needed clean entry. They needed realistic targets. They needed fast protection when reaction appeared. Some shorts could work, but they still needed failed reclaim. Blind selling into lower daily memory can trap the trader. The daily plan for next week is clear. If price reclaims the May and February daily upper boundary area and holds above it, longs can form. But price must stay. It must build distance. It must not return quickly. If price cannot reclaim that upper area, the daily chart remains trapped. Then shorts can form after failed recovery. If price loses the May daily lower boundary and cannot reclaim it, the next pressure moves toward February daily lower memory. But again, no chase. The trade must start from the line. Now look at the behavior. May upper boundary gets tested. It cannot hold. Price returns inside. May lower boundary gets tested. February lower boundary comes into view. The daily chart explains the week. The 1-hour chart kept giving movement, but the daily chart kept removing freedom. That is why the trader must adapt. If price is above the daily box and holding, use long continuation. If price is inside the daily box, use rotation logic. If price is below the daily box and failing to reclaim, use short continuation. But do not mix them. The daily chart does not give an entry alone. The session gives entry. The daily chart tells whether that entry has space. That is the lesson. Price reaches upper memory. It cannot stay. It returns inside the box. Then, the 1-hour trader must stop chasing and start waiting for proof. The weekly chart loses the upper memory. Then the larger rotation comes back. This week breaks below the February 1st weekly basis box upper boundary. It also breaks below the May 1st weekly basis box lower boundary. That matters. The February upper side fails. The May base fails. Now price is testing the area near the March and April 1st weekly basis box upper boundaries. The weekly chart is not free. It is rotating inside stacked memory. Look back at the structure. Since February, price moved between the first falling trend line and the second falling trend line. Then price broke upward from that trend line area. That looked important. But the breakout did not create clean continuation. Price moved sideways again. It could not run. It could not stay away from old memory. Then it rotated back down. That is the weekly trap. A trendline break can look powerful. But if price cannot move away, the break becomes fragile. The chart gives hope. Then structure pulls it back. Now look at the weekly basis boxes. March 1st weekly basis box forms inside the February 1st weekly basis box. April 1st weekly basis box forms inside the March 1st weekly basis box. May 1st weekly basis box forms near the upper boundary of the February 1st weekly basis box. From March forward, the weekly basis boxes keep compressing. Compression keeps stacking. The market keeps folding into itself. That creates pressure. But compression alone does not give direction. Direction appears only when price leaves and holds. This week, price did not hold above. It broke back below. It moved under the May 1st weekly lower boundary. It moved under the February 1st weekly upper boundary. Then it started testing the March and April upper memory area. That explains the 1-hour chart. Why did upper 1-hour longs stall? Because weekly acceptance failed. Why did short setups appear after failed recoveries? Because the weekly chart was rotating down from old memory. Why did some targets need caution? Because weekly support zones were still below. The weekly chart does not say sell every candle. It says upper freedom failed. That is different. A trader still needs 1-hour proof. Shorts need failed reclaim. Longs need real holding. No trade remains valid inside compression. The 120 moving average also matters. Last week, price was under major overhead structure. The December basis box lower boundary was above. The 120 moving average was also above. Price could not break through that overhead pressure. Then rotation returned. Now this week confirms that failure. Price moves back under weekly memory. The weekly structure says the market is still trapped. Not clean downtrend. Not clean uptrend. Stacked rotation. Failed acceptance. Compressed range. That is the environment. Now the plan for next week. If price remains below the May 1st weekly lower boundary, short pressure remains active. The next downside tests can continue around the March and April 1st weekly upper boundary area. If price tests those lines and holds, reaction can come. If price breaks below them and cannot reclaim, lower rotation can continue. If price reclaims the May 1st weekly lower boundary, the short pressure weakens. If price reclaims the February 1st weekly upper boundary after that, the weekly chart begins to repair. But reclaim alone is still not enough. Price must stay. Price must build distance. Price must not return the next candle. The falling trend lines still matter. The rising trend lines also matter. The chart shows those trend lines spanning in similar proportions. Watch how price moves between them. A line break is not enough. Distance after the break matters. If price breaks and stalls, the trap remains. If price breaks and holds, the environment changes. That is the weekly execution frame. The weekly chart sets the pressure. The 1-hour chart gives the entry. Do not use the weekly chart to enter blindly. Use it to know where the 1-hour trade is fighting. This week, the 1-hour longs were fighting the weekly wall. This week, the shorts had help after failed reclaim. Next week, the same rule stays. If price cannot reclaim weekly memory, the short side stays cleaner. If price reclaims and holds, the long side can return. If price rotates between weekly lines, the account waits. The weekly lesson is simple. Price broke out. It could not move away. It returned under memory. Now every 1-hour trade must respect that failed freedom. The monthly chart still asks for confirmation. May is testing the lower boundary of the 2026 first monthly basis box. That area sits near the 0.5 level. That matters. The monthly chart moves slowly, but it controls the larger field. A 1-hour trade can look clean. A daily breakout can look strong. A weekly bounce can look alive. But if the monthly chart is still under a major boundary, price can fail quickly. Now ask why May moves like this. April formed between the 0.33 area and the 0.5 area. It did not reclaim the full upper structure. It stayed in the lower half. March had an upper wick. April confirmed that upper wick. Then April overlapped the February monthly drop. So May does not start clean. May starts inside old damage. February pressure remains. March rejection remains. April overlap remains. Now May is testing the 2026 first monthly basis box lower boundary. For monthly upside to become cleaner, price must reclaim that lower boundary and change location. It must move from below the box to inside or above the box. Without that location change, the monthly rise is not confirmed. A touch is not enough. A wick is not enough. A single strong candle is not enough. Price must stay. The 2026 first monthly basis box itself formed overlapping the lower boundary of the 2025 first monthly basis box. That is important. Old yearly memory sits there. Current yearly memory sits there. The 0.5 area sits there. May is not fighting a small line. May is fighting stacked monthly memory. That explains the lower time frames. The daily chart tried to break above February and May daily upper memory. It failed. The weekly chart tried to hold above May and February weekly memory. It failed. The monthly chart still has not confirmed above the 2026 lower boundary. The same message repeats. Price can push, but it has not stayed free. That is why 1-hour trades must be treated as trades, not predictions. Take the entry. Respect the stop. Use the target. Trail only after distance appears. Do not turn a 1-hour long into a monthly belief. Do not turn a 1-hour short into a collapse story. The monthly chart gives location. The 1-hour chart gives execution. Now the next monthly plan. If price reclaims the 2026 first monthly basis box lower boundary and holds, the environment improves. Daily and weekly longs can get more space. Targets above can become more realistic. But price must hold. If May fails at the 2026 lower boundary, lower rotation stays alive. Then the 0.33 area remains important. The February monthly damage remains active. The weekly chart can continue to rotate under pressure. The daily chart can keep rejecting upper boundary attempts. That is the danger. Now connect all frames. The monthly chart shows the battlefield. The weekly chart shows the pressure. The daily chart shows the working range. The 1-hour chart gives entry. This week, the 1-hour chart showed trades. Some worked. Some were skipped. Some looked clean but lost quality. The daily chart explained why upper moves failed. The weekly chart explained why price rotated back under memory. The monthly chart explained why the whole market still needs confirmation. So next week does not start with a fixed opinion. It starts with the monthly boundary. Can price reclaim the 2026 first monthly lower boundary? Can the weekly chart recover May and February memory? Can the daily chart reclaim and hold the May and February upper area? Can the 1-hour chart create distance after the session line breaks? If yes, longs can form. If no, shorts remain active after failed reclaim. If price stays between the same memories, no trade remains valid. That is the full plan. No prediction. No fixed bias. Only location. Only reaction. Only execution. Price reaches the monthly boundary. It reacts. It either changes location or returns again.